Rising geopolitical tensions are rapidly increasing tea production costs and affecting the global supply chain. This pressure starts at origin with surging fertilizer and fuel costs driven by the Middle East conflict. These are critical as fertilizer affects yield and fuel is essential for every stage of production. But from field transport to factory operations, the crisis mounts. From India, Kenya, Sri Lanka to Japan, producers are signaling the impact. Tea manufacturing remains energy intensive, particularly during the drying phase, where oil-fired systems are still widely used. As one Japanese regional governor noted, rising fuel costs are expected to push production costs higher over time, with direct implications for export pricing. But the more immediate disruption is logistical and far more consequential. The Strait of Hormuz, a critical maritime choke point, is now constraining vessel movement into the Gulf. For the tea trade, this is not an abstract risk. Dubai functions as a central blending, packing, and re-export hub, particularly for high-volume, value-added teas produced by multinational firms, including Lipton and many private label manufacturers. When shipments are delayed or blocked en route to Dubai, the disruption cascades. Bulk teas from origin cannot reach the blending facilities. Blending schedules are interrupted. Packaging lines sit idle, and finished goods are delayed for export. This creates a bottleneck not just for raw tea, but for finished, ready retail tea destined for Europe, North America, and emerging markets. The consequence is a shift in where inventory risk sits. Traditionally, retailers worry about upstream supply, crop size, auction prices, and freight rates. Now the risk is midstream. Tea that exists has been purchased but is physically stranded in the system. For buyers in the UK and Germany, key re-export and packaging centers themselves, this introduces a second layer of uncertainty. Many rely on semi-finished blends arriving from hubs like Dubai for final packaging and distribution. Delays at that stage ripple directly into retail availability. This situation is particularly acute for large-scale, standardized blends where consistency depends on multi-origin sourcing and centralized blending. If one component from origin is delayed, the entire blend formulation can stall. And this is where the cost story becomes complex. Higher input costs at origin are one layer, freight volatility is another, but disruption to value addition hubs introduces a third, operational inefficiency. Factories running below capacity, rescheduling production, and managing fragmented arrivals all drive up per-unit costs. These are rarely visible in auction prices, but they are very visible in margins. For Japan, the implications extend further. Export-oriented regions are already seeing margin compression from energy costs alone, even before factoring in logistics. For countries dependent on long-distance shipping routes, such as Sri Lanka, India, and East Africa, the exposure is even greater. There is no longer localized disruption. It's now systemic. Business insight. What we are seeing is not a single shock, but a stacking of shocks across the value chain. Energy inflation increases production costs. Geopolitical instability disrupts logistics, and centralized value addition models amplify both risks. The industry has spent 2 decades optimizing for efficiency, consolidated blending hubs, just-in-time logistics, global sourcing. That model is now under stress. The immediate implication is cost escalation and delivery uncertainty, but the structural implications are important as well. The tea trade may be forced to reevaluate where value is added and how risk is distributed across the supply chain. In practical terms, that could mean more decentralized blending and packing, greater inventory buffers, and a shift away from single hub dependency. because in the current environment, efficiency is no longer the primary objective. Resilience is. China is opening the door to African tea, but only for those who can meet a new and very specific set of rules. Effective May 1st, the General Administration of Customs of China will grant zero tariff access to exports from 53 African nations. On the surface, that's a significant shift. It creates a potential alternative market at a time when African tea exporters are facing rising barriers to entry in Europe. But the reality is a little more complex. It's not a simple tariff reduction story, it's a compliance story. To qualify for zero tariffs, exporters must demonstrate that at least 40% of the product's value has been added within Africa. For tea, that means more than just harvesting and shipping. It requires meaningful domestic processing, sorting, grading, packaging, and clear documentation that proves transformation at origin. It favors orthodox production, for example, and packaging and blending within the country. That alone will reshape how some exporters think about their supply chains, but the bigger hurdle is regulatory. Under GACC Decree 280, which moves into full enforcement within 60 days, all food exporters must be registered in China's CIFR system. That's the China Import Food Enterprise Registration Platform. If a factory is not registered, the shipment doesn't clear, full stop. That means zero tariff benefit is effectively irrelevant unless exporters are already inside the system. And that's where the risk sits today. Many African tea producers, particularly small factories and independent processors, are not yet registered. The process requires documentation, facility audits, and alignment with China's food safety and traceability standards. So while the policy opens the door, the compliance threshold determines who can actually walk through it. Now, layer this against what's happening in Europe. The EU remains a primary destination for African tea, but tightening enforcement of maximum residue levels is raising the bar significantly. Exporters in countries like Uganda, Tanzania, and Zimbabwe are already navigating higher testing costs, stricter compliance, and increasing rejection risk. So the industry is being squeezed from both sides. Europe is tightening the standards while China is in the opening access, but only for those who can meet a different set of regulatory requirements. The result is not a shift from one market to another. It's a segmentation of trade flows. Compliant, well-capitalized exporters may gain a second outlet, China as a volume market alongside Europe. Others may find themselves increasingly constrained, facing higher costs in Europe with limited ability to pivot. Business Insight. This is a structural turning point. China is not just offering tariff relief, it is redefining market access around compliance infrastructure. Digital registration, traceability, and value-added processing are no longer optional. They are prerequisites. For African tea producers, the message is clear. Market access is no longer determined solely by price. It's determined by whether your systems align with your buyer's regulatory architecture. And in this environment, compliance isn't just a cost, it's a competitive advantage. A significant cash flow event is about to hit U.S. tea importers. U.S. Customs and Border Protection has confirmed that the first phase of refunds for duties imposed under the International Emergency Economic Powers Act, or IEEPA, will begin rolling out April 20th. This is not theoretical, it's an operational opportunity. The mechanism's new tool is called CAPE, the Consolidated Administration and Processing of Entries. It's deployed inside CBP's Automated Commercial Environment, or ACE portal. Importers who paid IEEPA-related tariffs over the past year now have a defined pathway to recover those funds. Here's the key detail. Phase 1 is limited in scope. Eligible entries only apply to unliquidated entries and entries within 80 days of liquidation. Excluded for now are the more complex cases, entries tied to drawback claims, open protest, AD/CDV exposure, or those already finalized. For tea companies, especially those importing from China under layered tariff regimes, this matters. Some firms have been carrying six-figure duty burdens on inventory. This process begins to reverse that. But the burden is on the importer to act. CBP requires verified access to the ACE portal, enrollment in ACH refunds programs to actually receive the bank payment, submission of entry data via CSV uploads, and internal reconciliation of which duties fall under IEEPA versus other tariff lines. In practical terms, this is a data exercise as much as a legal one. Companies need to isolate affected entries, segment them by eligibility, and prepare filings immediately. Phase 1 will process the majority of straightforward claims, but not all. Additional phases are expected to capture the more complex scenarios. There's also a timing dimension. Refunds will be aggregated and issued electronically based on liquidation or re-liquidation cycles. This means delays in filing could translate directly into delayed cash recovery. For tea importers already managing margin compression from elevated freight costs, tightening EU MRL compliance requirements, and volatile auction pricing, this is a rare new-term financial tailwind. Business insight. This is less about compliance and more about liquidity. The companies that move fastest will effectively convert last year's tariff expense into working capital in quarter 2 and quarter 3. Those who delay will leave cash stranded inside the system. Given current market conditions, that's not a trivial mistake. Subscribe free to the T-Biz newsletter for filing guidance and technical instructions, and see CBP's website for rollout details.
Produced by Audavita Studios. Connect your voice to the world.